At the conclusion of this lesson, you're going to be able to compare and contrast different types of mortgages. Historically, a red door has been a symbol of protection and refuge. In Scotland, however, it signifies that the home's owner has paid off the mortgage. Paying for a home is a big decision in your life. Whether you rent or buy, it is a big decision that you may face multiple times throughout your life. Almost 2/3 of homeowners have a mortgage. Most people don't own their homes. The bank does. The majority of Americans finance their homes in an arrangement where the bank purchases the property, holds the deed, and you make mortgage payments until the loan is paid off or you move. Home loan details are extremely important. The majority of Americans finance their home over a 30-year period and typically move within 5 to 15 years, thus starting the 30-year mortgage over again on their next home. Financial troubles usually arise not from the house itself, but the financing details and how it affects your cash flow, net worth, and overall lifestyle. Down payment is typically 20% is what's recommended. If it's less than 20%, you either need to purchase a private mortgage insurance or split your loans and do a second loan for the amount over 80%. For example, 80% 30-year fixed, 10% 10-year fixed second loan, and 10% cash down. The private mortgage insurance will terminate once equity reaches 22% or more. This lists the different types of mortgages that we'll cover. A conventional home loan is either a 15 or 30-year fixed conventional home loan. The interest rate is fixed. 30 years, the 30-year loan is the most common mortgage. 90% or more mortgages are 30-year mortgages. The interest rate is generally 0.75% higher for a 30-year loan over a 15-year loan. So a 15-year loan versus a 30-year loan.
In this video, we're talking about a 15-year versus a 30-year mortgage.
Pause my video now and go to Classroom and watch this video. Then come back to my instructional video to continue through the lesson. So you're going to get to have some practice with an amortization calculator online to see how much more interest is paid when using a 30-year loan. This is one of the biggest mistakes made in personal finance. Typically, a home should be purchased on a 15-year mortgage. So here's the online calculator. Let's just, I'm going to copy amortization calculator online. And I'm going to Google it. Okay, so let's say we take out a loan, a mortgage for $165,000, 30 years. Total interest paid, or the total, including the interest, or monthly payments. So the total principal paid is going to be that, and then the total interest paid is this for a 30-year mortgage, which is a lot. Let's change this to 15 and calculate. Oh my goodness, yes, greatly reduced in a 15-year loan. But look at the monthly payments. That's pretty high. So adjustable rate mortgage, or ARMS, has a variable interest rate. It's usually slightly lower interest than a 30-year fixed. It's amortized over 30 years with interest able to adjust. 5/1 adjustable rate mortgage is where the interest is locked for 5 years and then can be adjusted every 1 year after that. There's more in the fine print for that. It ends up being similar to a 30-year conventional mortgage. It's worse if the interest rates rise. You typically avoid adjustable rate mortgages unless you're positive you'd move or refinance within the fixed period before the rate could potentially adjust to much higher. Balloon mortgages are mortgage loans where a scheduled payment is more than twice as big as any of the previous payments. Before the Great Depression, most mortgages were 5 or 7 year balloon mortgages. Borrowers would make interest-only payments on the mortgage for 5 to 7 years. At the end of the term, the borrowers would pay the loan off in full. More recently, between 2001 and 2006, a balloon feature was common in subprime mortgage lending. At that point, most borrowers tried to refinance their loans just before the balloon came due. When housing prices tumbled between 2006 and 2009, many borrowers who expected to sell or refinance their homes couldn't. Ultimately, many borrowers with balloon loans defaulted and had to leave their homes. Today, lenders can still issue balloon loans, but most don't. Government-issued or government-insured home loans include the following: an FHA loan. Federal Housing Administration Mortgage Insurance Program is managed by the Department of Housing and Urban Development, which is a department of the federal government. FHA loans are available to all types of borrowers, not just first-time buyers. The government insures the lender against losses that might result from borrower default. An advantage to an FHA loan, this program allows you to make a down payment as low as 3.5% of the purchase price. But a disadvantage is you'll have to pay for mortgage insurance, which will increase the size of your monthly payments. A VA loan, the U.S. Department of Veterans Affairs offers a loan program to military service members and their families. Similar to the FHA program, these types of mortgages are guaranteed by the federal government. This means the VA will reimburse the lender for any losses that may result from borrower default. The primary advantage of this program, and it's a big one, is that borrowers can receive 100% financing for the purchase of a home. That means no down payment whatsoever. Then there's the USDA RHS loans. The United States Department of Agriculture offers a loan program for rural borrowers who meet certain income requirements. The program is managed by the Rural Housing Service, which is part of the Department of Agriculture. This type of mortgage loan is offered to rural residents who have a steady, low, or modest income and yet are unable to obtain adequate housing through conventional financing. Income must be no higher than 115% of the adjusted area median income. The AMI varies by county, and see the link for details on that, which the link isn't here. Maybe down here farther. A homeowner who is 62 or older and has considerable home equity can borrow against the value of their home and receive funds as a lump sum, fixed monthly payment, or a line of credit. Unlike a forward mortgage, the type used to buy a home, a reverse mortgage doesn't require the homeowner to make any loan payments. Instead, the entire loan balance becomes due and payable when the borrower dies, moves away permanently, or sells the home. Owner or seller financing means that the current homeowner puts up part or all of the money required to buy a property. In other words, instead of taking out a mortgage with a commercial lender, the buyer is borrowing the money from the seller. Buyers can completely finance a purchase in this way or combine a loan from the seller with one from the bank. A mortgage escrow. A mortgage payment consists of one part that makes up the principal and interest. The other part goes into your escrow account. Your escrow account pays for your homeowner's insurance and taxes. It is the lender's best interest to require an escrow account to ensure that these payments are made. Otherwise, if it is not paid, you could have liens against your house. TC's 2 cents. Do a 15-year mortgage. Have at least 10% down, ideally 20% or more. If not 20% down, pay off the second small loan quickly. No one does a 30-year loan and invests the difference. You will build net worth much faster by having a 15-year loan. So in closure, shopping for mortgages and knowing the different types of mortgages will save you money. So go to our classroom now and work on the mortgage comparison doc.